This presentation is about the audit procedures of Fontara Cooperative Group Limited. It's a multinational cooperative company that listed in NDX with headquarters in New Zealand. It manufactures and sells dairy products, which include milk, butter, cheese, and ice cream. It is the largest company in New Zealand that exports approximately 30% of dairy products to the world. Generally, there are two reasons of why Fontara is audited. The first one is legislative requirement. Under the Regulation of Financial Market Conduct Act 2013, all issuers that issue shares in the market need to be audited. As Fontara is a listed company, it is the issuer that must be audited. The second reason is the underlying benefits of having an audit. Audit reduces the information asymmetry between the users of the financial report and the cooperative management. It provides assurance to investors for decision-making. It also monitors governance and ensures that company's management are well-behaved. Audit reduces the cost of capital by which potential creditors may offer lower interest rate and potential investors may accept lower rate of return. It also improves entities' credibility and reduces the risk of fraud. The relevant stakeholders who may concerns include shareholders, bankers, customers, suppliers, and the government. Shareholders are concerned because they invested in the company and expected a better return. Bankers are concerned about whether the company is able to meet their obligations. Customers and suppliers are concerned as they are important parts in the supply chain. Government concerned as they collect tax from the Fontara. I found out three inherent risks existing in the operation of Fontara. Inherent risk refers to the possibility of material misstatements could occur in management assertions. We assume there is no related controls as it exists independently of the audit, which means the actual level of the risk cannot be changed. The first inherent risk is on liquidity. Fontara has a total borrowings of $6,536 million in 2019. That includes $1,175 million of the current and $5,361 million of the non-current. Compared to the amount of total equity, it's risky the borrowings actually take up a greater portion in the total assets. There is another risk of repaying the current borrowings when they fall due, because net cash flow from operations is $1,123 million, which is unable to cover the current borrowings. There will be an issue of going concern if Fontara is not able to repay their debts. The news also states that Fontara became more independent on debts since 2016. The second inherent risk is on valuation of property, plant, and equipment. Because the depreciation rate is in estimation that cannot be directly observed, the accounting policy of depreciation allows choice to be made on depreciation base, so it needs professional judgment and management experience to ensure that the company is using an appropriate method to calculate depreciation. And the figure of property, plant, and equipment is significant. $6,512 million that takes up 38% of the total assets. If there is any material misstatements, it will have a significant impact on company. The third risk is on inventory revaluation. Due to the nature of the dairy products, it has a short life and easy to get expired. This increase the risk of recording inappropriate inventory, which is about to expire. So Fontara needs to have an effective control to monitor inventory. The valuation of inventory is $2,944 million, so the misstatements on valuation of inventory will have a greater impact on company. Then we come to the control risk. The first control risk is also on inventory. It's an important item on balance sheet, so the company must make sure it is properly recorded. There are several risks that relate to the inventory. The record and the label of expired products were not properly kept and communicated by the warehouse workers. The counting of the inventory may include a product that is already expired. All the risk will increase waste, and the inventory ready for sale may be overvalued and gives the user an incorrect amount of total assets. The second control risk is the cash flow. As mentioned in the assessment of inherent risk, Fontara has a poor liquidity. They have problems to repay the short-term borrowings. This shows that the cash flow was not properly managed to meet their obligations. This is crucial to company's future operations. The third risk is on property, plant, and equipment. The property, plant, and equipment has a material figure that increases the impact of miscalculating the depreciation. The choice of depreciation base requires professional judgment, which is subjective and cannot be directly tested. So it's risky that there's no regular assessment of depreciation and no proper evaluation on the fair value of the PPE. The risk level of inherent risk is relatively high, as there is no related control to reduce the risk. There is a high risk on liquidity also. The control risk is low because Fonterra is a large company that has nearly 20 years history with developed and mature corporate governance. They have audit committee, internal audit, and external audit partners to improve controls regarding the risk. The detection risk is medium, refers to the risk matrix table. As Fonterra has low control risk and high inherent risk, the auditors need to perform medium level of audit procedures. The one financial report item that I select to be audited is inventory. Firstly, it has a material figure. It's the largest current asset, taking up 50% of the current assets as shown in the picture above. So it will be a significant impact if there is a misstatement. Secondly, the inventory turnover ratio showing an adverse trend. So what is days in the inventory turnover? It's the number of days the company takes to sell and replace their stock. It also provides an insight of whether the company is managing its stock properly. In 2018, the days in inventory turnover of Fonterra is 61 days. In 2019, it became 63 days, with showing an inventory sold in a slower rate than last year. It is unfavorable because the longer the inventory in stock, the likely it will get expired. Then how to perform the audit strategy? Normally, we have two types of audit procedures, test of control and substantive approach. The test of controls ensures the controls are implemented as they were designed. It evaluates the evidence obtained from the client and assesses the level of control risk. It is performed when there is a low control risk and effective internal controls. Generally, it places resilience on the internal control and tests whether they are effective. Substantive approach is performed when the asset level of control risk is high, relevant internal controls are unlikely to be effective, or it's inefficient to obtain evidence of relevant internal controls. It has two general audit methods, analytical procedure and test of details. For Fonterra, I choose to perform both test of control and substantive approach. The first test I will perform is observing the assessment of expired inventory. How does the Fonterra's warehouse observe and record the expiry date for every product? I will visit the warehouse and check if there is any products out of the expiry date. The second test I will perform is observing the internal control of stock monitoring and counting. How does Fonterra label and count the inventory in stock? By visiting the warehouse and obtaining the company's policy on stocktake, I would suggest perform actual stocktake by an independent auditor, then matching the value of stock to see if Fonterra properly record and document the value of the stock for reporting purpose. The last test is observing how the information of stock flows through departments. I will check if the value of the stock is properly sent to other departments. The substantive procedure is performed to assess accuracy evaluation and allocation assertion. I will first obtain the amount of expired inventory from the client and match the amount with related document to see if Fonterra has properly recorded their inventory. I will recalculate the amount of any provisions relating to the expired inventory to see whether the amounts are consistent. If no material difference is detected, I will agree on the value. Then I will also obtain the treatment and the policy of inventory write-off, and then reviews the actual process to see whether they operated in line with the policy. I will check whether all expired products have been written off and correctly recorded by obtaining more audit evidence from Fonterra. A test on the sample inventory selected is helpful to verify the expiry date and the actual process of write-off. By performing test of control and a substantive approach, we reach the conclusion that Fonterra has effective inventory control and the value of inventory is fairly and properly recorded.